Boy, do I have a good one for you guys here. I set out when I went to come up with the idea and the concepts for this video to talk about something called a volatility skew. It's probably something that you've never heard before. It's probably something that if you have heard, you're like, who cares? It's not really a big deal to me. So my goal originally with this video, with this content, was just to kind of talk briefly and let you guys know what volatility skew is, what it looks like, why it was created as more of an educational way so you guys can learn a little bit about volatility skew, and it's something that has involved the options market. Now, when I really looked into it, when I looked deep into the numbers, I did a major study that showed that when volatility skew is different than it normally is, and 98% of the time it is normal, 2% of the time it's not. When that 2% of the time shows up, it's a huge tell. It's a huge tell, a directional tell of where a stock is going in the short term. So again, guys, I'm super pumped. I'm super pumped to share this information with you guys. Again, I didn't set out to unearth the data and the statistics that I did, but as it turns out, when volatility skew is atypical, and don't worry, you might be like, Steven, I don't know what volatility skew is. Don't worry, I'm going to show you exactly what it is. But when it's atypical, it is a massive tell of the short-term price movements of a stock. So guys, get excited. I'm excited. I'll see you guys inside the computer. You're going to be able to make a ton of money from this. So clicking buttons, I'll see you guys inside of there. Okay, guys, we're inside the computer. Again, I'm super pumped. I am super pumped about this because I didn't think I was going to unearth some of the information and some of the data that I did when I started out coming up with these slides for this brief video. That's why I'm so pumped about this, and I can't wait. I literally cannot wait to see this in action, because the numbers that have come out of this study that I ended up doing based off volatility skew are mind-blowing. You guys are going to be drooling when you realize the type of money that can be made from this video. So make sure you pay attention. If you don't understand everything I talked about in this video after the fact, hit me up in the comments below, email me, whatever you guys need. This is really critical. This is a huge tell. There's something going on within volatility skew that's a huge tell, an enormous tell for the short-term price movement of a stock. And look at me over here on the left, guys. I'm super pumped. If I had to take this photo again, I'd be smiling, doubling the size that I did right now. That's what amazing is. So volatility skew, it's something you may have heard before, something you may not have heard before. It doesn't matter. I'm going to tell you exactly what volatility skew means to you, and then I'm going to show you exactly how to take that and profit from it in an actually big time way with a very high likelihood of you making money. Mind-blowing stuff, guys. Let's dig right in. Skew? Well, volatility skew is a term used when speaking about options, and specifically options prices. So options, really quick, what are options? Options are agreements to buy or sell 100 shares of stock for every option we have at a predetermined date at a predetermined price. So all options expire. That's where you get a predetermined date from, and all options have a certain strike price. That is the agreed on price for the transaction. That is the agreed upon price. That's what options are. Don't worry, we have a ton of content on this channel about options. Don't worry about them too much right now. Right? And what is skew? Skew is the difference between options premium, the price of an option, for puts and calls that are the same distance away from the current price of the stock. So let's go into my trading platform and see what that looks like. I'm looking at DIA. I call these, and everyone calls these, the diamonds. DIA is the Dow Index ETF. So we have the Dow, that's a $24,000 index. DIA is the ETF tradable form of the Dow. And this is an excellent opportunity to see what skew is. So again, skew is the difference between options premium or prices, right? So an option premium is the price. So right now on the 245 put, the mid price is 187. That's the premium, right? That's the price, right? The difference between the price for puts and calls that are the same distance away from the current price of the stock. So what I've done down here is I've tried to locate the strike price $10 above the current price of the stock and $10 below. That gives me the same distance away from the current price of the stock. So if we go to the call $10 above the current price of the stock, we're looking for the 256 call. 256. Well, let's call it the 255 strike. Right now, the price of the 255 strike is about 30.5 cents. However, if I go down to the 236 put, it's 59 cents. So it's a little bit more than 75 cents more than the price of the call that's the same distance away. Remember, the call that's $10 away is about 30 cents. And the put that's about $10 away is 59 cents. So it's about half of the price of the put. That is normal volatility skew. That is normal volatility skew. And we'll explain here why in a second. But options were not always priced this way, and that's kind of why this becomes interesting. So why skew? Well, skew was added to the price of options following the crash of 1987. So the crash of 1987 saw the Dow, the S&P 500 all crash about 30% on a given day. And before that, options had the same value just depending on their distance away from the current price of the stock. So we're right now, the call $10 away from the current price of the stock, and the diamonds is worth 30 cents. On the put side, it's worth 60 cents. Back before the crash of 1987, they were worth the same. Right? And it was added in as a way to signify the directional risk of an asset. The reason it was added in is because the value of options rise as stocks go down. Right? And stocks obviously went down 30% on a given day. So the value of those puts will go up greater than the value of those calls for a 30% down move, or any down move really. So what happened is the price of puts, for the most part, rose because of the downside risk. Risk is always kind of perceived as being on the downside, right? So again, the side, put or call, with the greatest skew is seen as the side with the most risk when it comes to the sensitivity of price movement and the increase in volatility. Don't worry if you don't know exactly what those things mean right this second. Hit me up in the comments if you really want to know. You don't need to really know that information for what the outcome of this video is going to be. But if you have any questions, I could do another video on this information. Just hit me up in the comments below. But that's pretty right. That makes sense, right? The risk is always to the downside. People in the stock market are always protecting their risk. So it makes more sense to build in premium to the options that are more sensitive to losing value or gaining value when prices go down, because again, risk is always perceived to be to the downside. We're always trying to protect our downside. We're always trying to lose less money, right? When we buy puts, we want to protect our downside if puts go down, or if prices go down. And that's pretty obvious, right? So while it's totally obvious to believe that there's always going to be skew to the put side or the downside, because a reduction in prices of a stock is typically seen as the only risk. No one really sees prices going up as being risky, right? So if people really only see a reduction in prices being risky, thus additional premium is added to puts due to the risk in stocks always being perceived as the risk being prices going down. Right? And again, that kind of makes logical sense. And this is where it got really interesting. So again, I set up with this video to kind of show you guys, hey, this is what skew is. Just so if you trade options, you have an understanding of why a call that's $10 away from the current price of the stock, in this case the 255 call, is far less expensive than the put the same distance away from the current price of the stock. Right? So again, I set out to kind of tell you guys that's how it is. But this is when it got nasty. This is when I went down that rabbit hole. Me and Alice, hand in hand, going down that rabbit hole. But what if there was a time when skew is actually reversed. It makes sense that the overwhelming majority of the time there would be skew to the downside because there's always perceived risk to the downside in any financial markets, right? Because downside risk is perceived as people losing money. The value of the asset, the value of the shares are losing money, right? So that makes total sense. But what if it was reversed? What if there was a time when the skew was actually reversed, right? If the skew was reversed, the call $10 away from the current price of the stock would be worth more than the put 10 distance away from the current price of the stock. So if it were reversed, the call would be worth more than 59 cents, right? So what if it were reversed? And remember, it makes sense that majority of the time we have normal skew, where puts same distance away from the current price of stock as calls are priced differently. Because again, the downside risk is always perceived as being the riskiest. Thus, there's a little bit extra value added to puts. But what if that were reversed, right? Where options premiums were greater on the call side than that of the put side when looking at the same distance away from the price of the stock. Could that be some sort of a tell? Right? Could that be some sort of a tell of price movement rather than just where the risk is? So volatility skew obviously is where the risk is. The risk, for the most part, the overwhelming majority of the time, is to the downside. But what if the skew was reversed and it kind of looked like there was risk to the upside? Right? First of all, does that even happen? Right? I didn't even know if that would happen before looking into this study. Does that even happen? And if it happens, is that some sort of a tell of where prices might go? Now, this is an absolute game changer. I'm telling you guys, this is an absolute game changer. So strap in, guys. We're going down that rabbit hole really, really fast. So here's the study that we did. Alcoa. 2007 to present. So about 10 plus years. I'm filming this at the end of December 2017. 2007 to present. 10 plus years of data. We have Alcoa, an industrial of the Dow. We have FXE, which is the ETF of the euro dollar. Twitter, you guys all know Twitter, a social media company. Apple, the largest company in the world. Over the last 10 years. And what we did was we checked to see how frequently there was normal volatility skew. Again, normal volatility skew is the price of puts that are the same distance, puts that are the same distance away from calls from the current price of the stock are greater value because the perceived risk is always to the downside. So we wanted to see how frequently that happened. And then if skew is irregular, meaning the price of calls the same distance away from the price of stock that puts are greater value than those puts, right? We wanted to see when that was irregular, right? We wanted to see how often that happened. And then what we wanted to see, remember, we wanted to see if it was a tell. We wanted to see what the price of the stock did. If the stock was higher 10 or 30 days in the future. Now, I want to just kind of show you guys something here to make it kind of known that we did not really curve fit this information. We did not curve fit this information. So I'm going to go back again. Let's see. Can we do 10 years? We can't. So what I want to do is I want to go to customize my list and I want to add a time frame. The time frame is going to be 10 years and let's call it a week. Great. And we're going to apply it. Did that work? No. Let's go here. 10 years, weekly. Great. So the first one we looked at is Alcoa. Now, as you can see, Alcoa is down a bunch from when we did this study about 10 years ago. It's down a bunch. What else did we do? FXE. FXE is a little bit down, up, down, up, down. Twitter is mostly down. And Apple mostly up. So we've taken companies from different sectors, right? We took an industrial, we took currency, we took some technology companies, all have gone up or down or sideways over the course of this study. And again, what we wanted to do is we wanted to see if the volatility skew was reversed. So calls being higher price than puts if we compare calls and puts the same distance away from the current price of the stock, we wanted to see if that was a tell. But I also want to show you that we didn't curve fit this. We didn't just have stocks that went in one direction. So we didn't have all stocks that went up, and we didn't have all stocks that went down. We had some stocks that went down, we have some stocks that went sideways in the study, and we have some stocks that went up. So that's what we wanted to end up doing, guys. That's what we wanted to do here. So again, we wanted to see how often skew was reversed, number one, and then what it looked like, what the stock looked like 10 and 30 days into the future after that reverse skew. So what you could see first off the bat is skew, normal skew, where puts the same distance away from calls are higher priced. And again, let's show you that again in DIA. In DIA, $10 away, the calls are worth 30 cents, and $10 away, the puts are worth 59 cents. That's normal skew. Normal skew. That happens 98% of the time in the last 10 years in Alcoa, 97% in FXE, 96% of the time in Twitter, and 98% of the time in Apple. Right? So we only see irregular skew 2, 3, 4, and 2% of the time. However, this is one of the most game-changing bits of information I've ever stumbled upon. It looks like there is a serious tell when there is reverse skew when looking at the price of the stock in the very short term. And what we did here was we said, okay, when there is irregular skew, meaning calls are priced higher than puts when comparing the same distance call and puts that they are away from the current price of the stock, right? So when there's irregular skew, Alcoa was higher, the price of the stock was higher 81% of the time when we look forward 10 days after we saw the irregular skew. FXE 84%, Twitter and Apple both 100% of the time. So with Twitter and Apple, when there was reverse skew, both Twitter and Apple were up 10 days later 100% of the time. FXE 84% of the time and Alcoa 81% of the time. After irregular skew, 30 days later, Alcoa was up only 49% of the time, FXE 51%, Twitter 44%, and Apple 65%. So guys, clearly there is a screaming actionable item here. If we ever see reverse skew, that is a screaming indicator, a huge indicator that the price of the stock will be higher in the very short term. And our definition of the very short term is 10 days in the future. As you can see, in some cases it worked 80% of the time. In other cases it worked 100% of the time. 100% of the time. So if we look at puts, and let's say puts $10 away from the current price of stock, and we see they're 59 cents, and then we go over to the calls that are the same distance away, and it doesn't have to be $10, it could be $1, it could be $2, it could be $5, it could be $30, whatever it is. And then if we go to the opposite side, the calls, let's say $10 away, and rather than this being 30 cents, let's say it was more than 60 cents. That would be an example of reverse skew. And we know when there is reverse skew, when calls that are the same distance away from puts are higher priced than those puts, right? When the calls that are the same distance away to the current price of stock than puts are, if calls are priced greater, that means 10 days in the future, there is a very, very, very high likelihood, that the stock will be up. That is truly, truly amazing. Truly amazing. Somebody knows something. Somebody's seeing risk to the upside when everyone else is thinking there's risk to the downside. That's what it means. So what are the takeaways? Skew is the difference between options premium, the prices, right, for puts and calls that are the same distance away from the current price of stock. You guys saw that a bunch of times with DIA. And skew is typically to the downside. And again, that makes total sense. People always have fear of the downside. People believe that there's risk to the downside. Thus, there's a little bit of padding in the prices of puts, right? That totally makes sense. So if we compare puts and calls that are the same distance away from the current price of stock, it makes total sense that the puts will be priced a little bit greater than those calls because, again, the majority of the time, as you guys saw, about 98% of the time, the risk is to the downside. But when the risk is to the upside, when calls are priced greater than puts that are the same distance away from the current price of the stock, right? That rare occasion, that 1 or 2% of the time that happens, we call that irregular skew. It is typically a sign that a short-term movement higher in the stock is more likely to happen than to the downside, at a rate of 81% for Alcoa over the last decade, 84% for FXC, 100% for Twitter, 100% for Apple. So if you guys see reverse skew, that is a screaming indicator, a screaming sign, flashing green, not red, flashing green because that means we're going to make money, that 10 days in the future, the stock will be higher. There's a very high likelihood that that happens. So there you have it, guys. Remember, what's so amazing, why I'm so excited about this, is I've actually never even used this. But you better bet I'm going to be using it from now on. So what did we talk about here in this video? Where skew. Skew was created after the crash of 1987, right? And there was a big sell-off the crash of 1987. And because of that, people believe, and people have added in premium to put prices because the perceived risk is typically towards the downside. But in the rare occasion where the perceived risk, according to the prices of options, is on the call side, meaning calls and puts that are both, let's say, $5 away from the price of the stock, if the calls are valued greater than the puts, that's what we call reverse skew. And when that happens, and by that way, that is very rare that it happens, but when it happens, stocks have a very high likelihood of being higher 10 days from that moment. As you saw with Twitter and Apple, over the last 10 years when there was reverse volatility skew, both Twitter and Apple were higher 10 days in the future 100% of the time. And Alcoa and FXC better than 80% higher. So again, this is a huge screaming tell that there is now risk to the upside and you should be taking advantage of it. So if you ever see reverse volatility skew, if you're ever looking at an options chain and you see puts and calls that are $5 away from the current price of the stock and the value of those calls is greater than the value of those puts, you better be pushing the buy button because you have a very high likelihood of the stock being higher 10 days in the future. Guys, don't think this is a very actionable one. I will be using this every single time I see it, guys. It's a big money maker. I'm glad you guys were here to be able to learn this with me. If you guys have any questions or you want to kind of go through things a little bit slower, a little bit more, hit me up in the comments. Do it, guys. Don't think. Be actionable here, guys. Be actionable. This is a very high probability trade. They don't come around very often. I'll see you guys in the next video.